This special podcast is brought to you by Future Growth Asset Management, and today I'm talking to Wafeeqah Mallick, who is a credit analyst with Future Growth, and she's going to be telling us all about credit markets. Wafeeqah, what is credit as an asset class, just to kick off with?
So credit essentially, well, the way I look at it is, if you look at a company's balance sheet, you'll see that assets are funded from either equity, which is shareholders' ownership in the company, or by debt. So basically, if a company wants to raise funding to grow the business, they'll either go to their shareholders and ask for money, or they'll come to banks or institutional investors and ask to borrow money. And that's where we fit in. So we lend money to good entities who we think have a good credit quality.
And how do you determine that? How are you determining whether they're worth lending to or not?
Yeah, so we have to perform our due diligence on the companies. There are credit rating agencies that provide credit ratings for debt. So it'll be about AAA to AA, and all of that links to the probability of default. But that really is just an input. We do our own due diligence. So when we look at analysis, we look at the fundamentals of the company. What does the company do? How do they make their money? How do they spend it? Who is management? Is management credible? What are the risks that they face? What are the industries that they operate in? How do they mitigate those risks? And all of that really just feeds into, is it a sustainable company? And do we like management?
So, Wafeeqah, what is the difference between equity and credit?
Yeah. So I think with equity investors, they're there for upside risk. So the share price can really shoot up and shoot the lights out, and you get capital appreciation and dividends. Whereas with credit, we're here to protect downside. And with equity, the dividends really is discretionary to management. Yes, directors give a sort of indication on what dividends they'd like to pay, but in the end, it's discretionary. So if the business is not doing well, they don't have to pay the dividends. Whereas with debt, they have to pay the interest. And that's where we look at the gearing metrics. We look at how much debt do they have in the books. Are they able to service their debt? And if not, it will be an event of default, and that might cause a restructuring process and all of that. So it's definitely rather downside risk because we don't see any upside. So we want to make sure that the fundamentals are absolutely strong, so they will be able to service the debt for the term horizon that we're looking at.
So what would be the biggest red flag to you when looking at a company?
So, well, as I mentioned, it was the gearing metrics. So if they're overly geared, where the company really looks to use funding, external borrowings to fund their business, and the owners of the business do not have enough skin in the game. So, and that would be really the equity side of the debt to equity ratio as a gearing metric, because we want to see management in there. We want to see that they want to grow the business and do the best for the business. And then, of course, there's other fundamental ratios around the interest cover ratio. But also governance is a key thing that we look at specifically here at Future Growth, where the economic, social, and governance ESG factors we focus on. So we want to see that the board of directors are suitably qualified, and that they have integrity, and that they run the board with good corporate governance, and that the auditors are on board, that we don't have shoddy auditors who might not do a proper work. And so we know when we look at the financials that they are not well accurate, but at least the auditors can assess that they have enough financial controls. And
okay, so
yeah.
It's quite an onerous process that
Yeah.
you take on to come up with a credit rating to ultimately include this credit in one of your funds. So a credit analyst is not only about quantitative analysis. There's a lot of qualitative and experience. In your opinion, what makes a good credit analyst?
So, yeah, as you mentioned, the fundamentals is very important. So you need to have a thorough understanding of how accounting works, because no matter what happens in the business, no matter what the economic outlook is, that all of that filters through in the numbers. So if you are able to unpack those numbers and sort of decipher any trends and have a forward-looking view, that's fundamental. But also there's a lot of soft skills involved with credit analysis. So you're dealing out with management. You have to deal with management and different types of personalities, and you're also dealing with different sort of individuals. So we're dealing with investment bankers and brokers and lawyers when we draft our legals. So it's a very diverse nature. You're not just sitting there behind your computer crunching numbers. So it's a lot of interaction with the market and understanding what are the market dynamics and how do we price these instruments. So a lot of interaction, and you have to be able to incorporate that all into your analysis and come up with the final rating and the final price
So it's a lot of kind of cognitive processing from different paradigms to come up with one answer.
Yes, definitely. Yeah.
And so in the context of retirement funds, they are able to invest in credit, and obviously there's a fiduciary duty on portfolio managers to deliver what retirees need. How is credit included in retirement funds in the South African context?
Yeah, so there's the Regulation 28 of the Pension Funds Act, and that sort of outlines the percentages that need to be invested in credit. And the reason behind that really is that credit is seen as a relatively riskless asset, although we think that there is risk in credit, as we've seen in the African bank saga and First Strike. There's definitely risk to credit, but relative to equities, it's considered lower risk, and with lower risk is the lower return. So while you might get a lower return on the credit assets, because pension funds, you need to pay out that money when individuals retire, etc. So there needs to be enough assets in a relatively safe environment, because these instruments, they mature at a certain age. So you will get your money back, barring any event of default. With equities, the market can be very volatile, and by the time the pensioner needs to withdraw his funds, the market might have crashed and there might not be anything left, whereas with debt is relatively more stable. So within the fixed income space, there's a spectrum of risk. So we start off with the vanilla bonds, that sort of your government bonds is considered risk-free. Then you move to sort of listed credit, which is listed entities issuing credit, and then your unlisted credit, which is more unknown names that you can structure your deals according to a bilateral negotiation, and you can get all the way down to your distressed debt, where some companies would buy failing companies' debt with maybe for 10 cents in the rand, with hope to receive 20 cents in the rand. And as you move down that risk spectrum, the return that you get will also increase, because the risk reward sort of trade-off that you get. So as future growth, we don't necessarily do the distressed debt scenario, but we can offer our clients exposure to different levels of risk, and we measure that typically by the credit quality, for instance, AAA or BBB or single B, and we can definitely tailor make our funds or segregated funds according to our clients' risk appetite, and that would then determine required return.
Let's just touch on that. You said quite a profound statement that credit is not riskless, which may be new to many people listening to this podcast. Why is credit analysis so important? I'm sure it's got to do with this inherent risk that is in credit.
So perhaps I can take you through what we call the waterfall effect. So if a company were to default and there's only X amount of money left in the business, that will have to be restructured and distributed. So if you follow the waterfall effect, usually the staff gets paid first, and the taxman gets paid first, and then the creditors, and then whatever's left, the residual, goes to the equity holders. And within that debt space, there's a couple of tranches. So you get the senior debt, you get subordinated debt, junior debt, mezzanine debt, all of that. So basically, where you fit on the scale, when the waterfall will determine how much risk there is. So if you in subordinated debt, although it's debt, it's close. The risk is closer linked to equities. So you need to understand exactly where do you fall in the waterfall and how much cushion there is really. So you have to look at, are there enough assets in the balance sheet? If there is a case of default, will we be paid? And that really falls into our recovery assumptions in our credit analysis, and that then feeds into the pricing that we price the instrument.
So Wafeeqah, the first port of call for a credit analyst is to determine what the probability of default is, and then if the company were to default, what amount you would get out as the investor.
Yes,
is that correct?
Exactly. That is the recovery that we look at. So again, if we look at the balance sheet, and I keep on referring to accounting because I am an accountant, but if you look at the balance sheet, it's made up of different types of assets. So although the assets, some might not be tangible, and some, so for instance, goodwill in the balance sheet. If the company, sort of fails, that goodwill means nothing. So we look at tangible assets, what is left now, how much of inventory, and if we were to get the inventory, we'll be able to sell it 100% of what's sitting on the balance sheet. So we apply certain haircuts. So we look at in cash can disappear in a second. So when we look at all of that, and we come up with a recovery rate that we expect that if this company were to default, we'd only say get 40%, which is 40 cents in the rand, for instance. And then we plug that into our models, and we're able to get a price from that. Yeah.
And from a future growth perspective, you are working in a very competitive space, especially because the margin between returns from credit is very small. What do you think, in your view, is the edge that Future Growth would have over any other credit analysts out there?
So, Future Growth, we have a big investment team. So, we have the fixed interest team that looks at sort of the interest rate cycles and makes calls on the interest rate and inflation and that. And we have the credit team, and that's split up between listed and unlisted. I'm specifically on the listed space, where we look at all the listed bonds. So equally, where you can buy and sell shares, you can buy and sell debt as well, listed bonds. And then we have the unlisted side that deals with not necessarily smaller companies. It can still be very big, well-known corporate companies, but sort of on a bilateral agreement, or we are able to draft our legal agreements to ensure that we have enough protections in place. And we have an agricultural fund. There's so much happening within this business. Although it's debt predominantly, there's so much facets to it, and we have a big team that looks at specific areas. But then also, it allows fluidity. Future Growth really sort of fosters fluidity within the team. So although I'm a listed credit analyst, I get involved with unlisted deals, sometimes some equity valuations if we have some equity in a business. So Future Growth really strives to produce investment analysts as opposed to purely listed credit analyst or unlisted credit analyst.
Okay, so it sounds like the flexibility and scale of the team at Future Growth allows you to take advantage of opportunities as they come along.
Definitely.
I've been speaking to Wafeeqah Mallick, credit analyst at Future Growth Asset Management. Thanks for your